Hey, Andrew here from The Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 13. And this is an episode that I had intended to actually cover last week, but with all the noise and news around interest rates, I pushed this one back to this week. So with a little bit of airspace on interest rates, I wanted to jump into this particular article because in a way, this one makes me laugh, and I get a little bit of joy and a chuckle out of this particular article, and you'll see why as we go through it. And this is actually somebody that, without using their name, I actually reference quite a lot when I have people ask me about the stock market and who to listen to and why I talk so much about where you get your information when it comes to the stock market. So let's have a look at this. It says Jim Cramer was dead wrong about this one stock prediction. So let's just pause there and reflect on why I'm talking about this particular article. And I don't necessarily, well, maybe I do a little bit, but I don't necessarily want to single out Jim Cramer, but this article does. And you'll see why I've focused on this one. But I often say to people that talk to me about stocks that there are three places that people get their stock tip or stock advice or information from. Friends at a barbecue, overheard somebody talking about the next hot stock on their commute to work, or from someone, talking head, on the news or in the media. And Jim Cramer is exactly that. He is a talking head in the media in the US in particular, and has built himself quite the reputation. Maybe not the one that he would like, but certainly built himself quite a reputation over the years. And you'll see why I say that with a smile on my face shortly. So dead wrong about this particular stock prediction. And then the next part, the inverse Cramer crowd is celebrating another win on Tuesday. So that should tell you a little bit about how well this went for Jim Cramer and why we're going to talk about the importance of where you get your stock information from. So Jim Cramer's been around a long time, and it's gotten to a point now where there are a group of people, a large group of people, who will actually invest in the inverse manner to which Jim Cramer suggests you should do it. So he has effectively built himself a reputation of getting it so wrong that there's now people out there who will bet in the opposite direction of what he is suggesting is going to happen. And that cannot be good for someone who is paid to give people information and I won't call it advice, but certainly to give tips on what's happening in the stock market when you have a whole group of people who have created the inverse Cramer. That could not be good for the ego. So anyway, this one in particular, he was talking up the shares of First Republic. And if you've been following the news in the US at all, you'll know that First Republic has plummeted. I think a little bit further down here, yes. So stock has fallen 89% since Jim Cramer said it was a very good bank. Now, it may very well be a good bank, but the risk of listening to people in the media for advice is that something like this can happen to you and you can end up with egg on your face. So fallen 89%, and then despite disappointing results, Cramer saw the bank's quarter in a positive light. Well, and again, this is one of the things, and I'm not going to focus on Jim Cramer here, but this is again one of the reasons why I am very cautious when I say to you things about be careful where you get your information from, because as I say, with a lot of those paid services, those stock tipping paid services, you are paying them money. So in return, they feel obligated to give you some form of tip. And they can't give you the same tip every month, which means they've got to come up with a new tip each month. And sometimes that's not necessarily a good thing, because maybe there just isn't something to tip each month that's different to the prior month. So in this case, Jim Cramer, he's read the first quarter results. They weren't that great, and he was still able to put a positive light on it. Now, that's not necessarily a bad thing or having a shot at him for doing that, but it's a common theme that we see with stock advisors, brokers, people who are in the industry and being paid for certain services, and they have to put potentially positive spins on things when they're not there. And that's why I often will say to you, be very, very careful where you get your advice from. So this article, I guess, continues on. You can see, look at that. That's where the advice was given, all the way up here, and the price all the way down here. So very, very scary, and a really good example of why I always say be careful where you get your information from. So just a quick, so there's nothing much more to this article other than bashing on Jim Cramer and the First Republic results, which are obviously quite bad, and it's had a massive impact on its stock price. So there's not much more to show about that. So what I want to really highlight here is what I said earlier about where you get your advice from. And my strongest recommendation that I can give you is that, and this is something that I learnt from Tony Robbins, is that success in life comes when you have a system. So listening to other people is not a system. That is just, it's almost like handing over control to somebody else. So you need to have a system that's repeatable. Successful systems are repeatable by whoever uses them. And I learnt that when I was learning how to trade foreign currency markets, is that because of the high loss ratio in trading foreign exchange, you had to have a system that took emotion out of the equation and was very rules based, so that you knew what to do. No matter what happened, you had a response based on your rules. And it's the same with stocks. You want a system that enables you to apply it, produce a result, and take action on that result. And listening to people in the media is not a system. It's a recipe for disaster. The inverse Cramer crowd would suggest that that is a good recommendation from me. That listening to people in the media is a risk, and it's not a system. So I want you to find a way to come up with a system that is repeatable and produces outcomes that you can act upon. Now, no surprise, I have one of those systems. I built that and I use it, and my clients use it. It's called my 7 stock selection criteria. If you're interested in it, reach out, leave comments down below, whatever you want to do to get access to that system. We can have a chat about how you can get access to it. But the 7 stock selection criteria is simply a system that is designed to assist you to make clear, concise, and repeatable stock investing decisions. And nothing is more important when it comes to the stock market than repeatability, because we're not about trying to pick something that's going to explode overnight, because that's a loser's game. Let's be brutally honest. There might be, somebody might pick 1 in 1,000 of those, and that's not a winner's metric. It's certainly not a way to wealth. So we're about picking stocks that have got good history, strong results, and a strong likelihood of being around in 5, 10, 20, 30 years' time, because we are long-term buy and hold stock portfolio builders. So that's the type of mentality you need to have when building your stock portfolio. It's not about chasing quick wins. That just is, again, it's a recipe for failure. And we're not about setting you up for failure. We want you to have that system that's repeatable, and we want you to be able to build your portfolio with confidence. And to do that, you need a repeatable system. So 7 stock selection criteria based on a lot of the lessons that I've learned from Warren Buffett and others. And using that criteria, we eliminate the rubbish. We eliminate the stocks that are not performing. We eliminate the stocks that haven't produced results in the past at this stage. And so that does mean at times that there might be the new Google coming from somewhere. Like look at the AI space at the moment, or lithium, another one, where people are excited to get into this, and there's a whole host of different organizations or companies that are involved in that space, and you'd be saying, well, which one is the one that's going to survive? And at this point, we don't know. So investing in all of them is not a great way to go about it either. And so the criteria that I use may mean that we miss out on some exponential growth in a particular stock. But it also means we don't get caught up in those that don't hang around, because not all of them will. If you think back to gold mining days and the very early stages of gold mining, and there was a heap of people getting involved. Now, if you invested in all of them, you would have lost a heap of money on most of them and made a lot of money on one. But would the two have actually resulted in you being in front? And that's the question, and it's a difficult one. And would you have been able to sustain the losses whilst waiting for that one to produce results? The same is going to happen whether it's in lithium, AI, even hemp, and the legalization of hemp in Australia. I know it's legal in the US, but if it was, the legalization here in Australia, when that happens, there are going to be companies that will profit from that, but it won't be all of them. So we wait until the market leader or the market leaders are identified, have produced results, and that results means profits, and then we get in, because we know we're backing the winning jockey and such. So I guess bringing it back to why I wanted to talk about this particular article, it is be very, very mindful where you take your stock investing tips or recommendations from. One of the things you'll find is I never make a stock recommendation, never ever, because it's a fool's game, and no one's paying me to do it, so I'm not going to do it. And like I said, it's a fool's game. It's just very, very difficult to pick individual stocks that are going to exceed people's expectations, because when you hand over that control to somebody else, not only are you handing over the control for the success, but you also, you're giving yourself someone to blame if it goes wrong. And that's not the winning mindset. It's not the way to build a successful wealth portfolio. You want to take full responsibility for what you're creating and do that using a system. So that's Woody's Weekly Wisdom, episode number 13. I hope that's given you some insight into the stock market and how to succeed, and in particular, how to avoid failing. And if you want to have a chat about getting access to the 7 stock selection criteria, reach out, book a time with us. There should be some links under this video to enable you to do that. And let's get building a stock portfolio based on a system and real criteria, and not somebody else's opinion, and avoiding scenarios like getting told that this is a good stock and then within a matter of moments it's down 89%. Hope that's helpful. Let me know in the comments, and I'll see you again next week. Cheers.